If you are asked to put up an asset as security for a business loan, a lien is put against the asset. The lien gives the lien holder first right to the asset and requires the loan to be paid off before you can sell the asset and get your money from it. Car loans are a good example of collateral, the value of the car, being used for a loan. How a company uses its assets to generate income can show its profitability. A financial ratio called net return on assets is a good measure of how the company puts its assets to work. You can get a value of your current assets, those you can quickly turn into cash, with a quick ratio. Add up your current assets, not including inventory, and divide the total by your current liabilities, what you owe and must pay back within a year. This number shows you how much cash you might be able to get quickly in an emergency. It's important to keep excellent records of business assets, starting with the purchase of the asset. Include all information on asset costs, on depreciation, on salvage value, repairs and maintenance, and any appraisals of the asset. Each of the main types of business assets is included on a business balance sheet. Cash and cash equivalents includes financial instruments that can be accessed quickly with little loss, like money market funds. Near cash, like accounts receivable and prepaids, including insurance payments and inventory. Personal property, like furniture and fixtures, machinery. Long-term assets like land and buildings. Every business needs assets to operate. It would be hard to run a restaurant, for example, without tables and kitchen appliances. Assets also are main items of value in a business, useful in getting a business loan or when selling the business. The value of a business to the owner, called the owner's equity, is the value of assets, what's owned, minus liabilities, what's owed. If you are wondering if a donation could impact your company's tax bill, there are some things you need to know about how different kinds of businesses can donate to charities. If your business is a corporation, the business can take a tax deduction for any donations, whether they are assets, cash, or investments. The deduction is considered a business expense on the corporation's tax return. If your business is not a corporation, and you're a sole proprietor, partner in a partnership, or an S-corp, you can't take a deduction for a donation on your business tax form. Instead, you can claim the deduction via your personal tax return, Form 1040, and you must itemize, using Schedule A. This deduction will reduce your personal income, but not your business income. Capital assets are long-term business property owned for investment purposes, including real property, land and buildings. They are subject to capital gains or losses, a different tax status than ordinary gains or losses. To set the value of capital assets, you may be able to use the fair market value. But in some cases, you may need to reduce the fair market value by the amount of any capital gain if you sold the property. If you're donating inventory, property your business sells, you can deduct either fair market value on the day you made the donation or its basis, whichever is smaller. The basis is any cost from a previous year that you would include in your opening inventory for the year you make the contribution. You can't include your contribution in your opening inventory. Intellectual property. Intellectual property includes intangible assets like copyrights, patents, and trademarks. If you donate any of these, use the basis, original cost, of the property or the fair market value, whichever is smaller. You may also be able to take an additional deduction in the year of the contribution and following years, up to a total of 12 years, based on the income from the donated property. Business cars and other vehicles. You can donate a business car or a vehicle used mainly on public streets, roads, or highways. If the fair market value is more than $500, you can deduct the gross proceeds from the sale of the vehicle or its fair market value on the day of the donation, whichever is smaller. Documenting the gift. How you document donations depends on the amount and the type of donation, cash or non-cash. It's your responsibility to get a letter from the charity that acknowledges the donation, whether you donate cash or assets. For all non-cash donations, you must get and keep a receipt from the charity. The IRS is clear in stating that, without a written acknowledgement, the donor cannot claim the tax deduction. For donations of $250 but not more than $500, you must have a written acknowledgement from the charity before you file your tax return or the due date of the return, including extensions. The letter should include the exact amount donated for cash donations. If your donation is more than $500 but less than $5,000, you must complete IRS Form 8283 non-cash charitable contributions and include it with your tax return, in addition to the acknowledgement. If your non-cash donation is more than $5,000, you must have at the time written acknowledgement and you must complete Form 8283 and submit it with your tax return. 7. There are also more special rules for donating vehicles, so check the IRS site or speak with a tax advisor to make sure you know how to. The increase in value will likely produce a capital gain which will result in increased taxes for you or your business. If you donate the depreciated asset directly, you'll only receive a deduction for the decrease in value. How you record a donated property depends on which tax return you are using. Corporations can record the cost of the donated property as a deduction on corporation tax return. For small businesses can't take a deduction for donations, but the owner may itemize their deductions and then record the cost of donations on Schedule A of their personal tax return.